Yeah, I think we just treat them as active and passive. Like in my opinion, I think dividends is all passive. I don't even have to look at it for quarters even. Just log into that account on a monthly basis just to put money in and just buy some stocks and then log out. That's all I do. There's no selling, you just buy and just let it fly. But for selling premium, like option premiums, you have to be pretty active. You have to spot like stock price volatility, like how and why things are like swinging, and if it makes sense or not. If it doesn't make sense, then you kind of act the other way and collect some premiums. Or if I'm holding a lot of solid blue chipper stocks, I tend to do covered calls and collect premiums that way. That strategy, you definitely need to be a lot more active, at least once a week, or maybe just 5 minutes in the morning. You see your top 10 picks or top 10 holdings and see if anyone are like swinging 5-10% even. Like if that's the case, then it is worthwhile to take a look at like making some moves, because collecting premiums is all about volatility, and that will eke out more profits for you.
So, I mean, you may need to make adjustments on the fly as well if you've sold something and it's going in a direction that maybe you weren't expecting. You end up having to make transactions at that point.
Yeah. And sometimes you do the short put and then you get a little bit greedy and you sell more contracts than you ever want to hold. Then you just have like, I don't know, 1,000 shares of some weed stock and continuously go down, then what? You're collecting a couple $100, but you're losing thousands, right? You need to know exactly what you're getting into, like if you really want to hold the stock or not, or you're just there to collect the premiums.
So on an individual trade, there is the risk that you could actually be cash flow negative once you collected the premium and then you had to buy something back, for example.
Yeah, as for compared to dividends, you can't go negative dividends, right? The worst that can happen is zero. They can cut the dividends, but 90% of the time it's just continuously just steady growth payouts for me.
I think my approach is similar. So for the dividends, I'm buying dividend stocks and, looking forward to the dividends when they start coming in next quarter, whenever they start. But of course, that requires a lot of capital up front. While with the options in a margin account, I don't need to have any cash on hand until I actually receive the stock if I'm doing puts, or if I lose the stock to cover calls, then I actually end up getting cash. But I guess the point is you don't need quite as much capital with options in order to be able to get the premium, as long as you're right in the direction.
Yeah, for dividend stocks, you just have one direction. Like you just want it to go up, but it doesn't have to go up. It can stay flat because you don't care about the stock price really. But for options, you have to care about the stock price. Like that's right. All you care about.
Obviously, the more volatility, the higher the premium. What sort of stocks then do you look for? With dividends, it sounds like you're more blue chipper, but with options, do you look for the volatile ones in order to collect more premium?
Yeah, usually, but I have made plays on these blue chip stocks. Let's say Enbridge, the pipeline stock. I went for the US market because there was actually a market in the for that in the US counterpart. And for that one, I think I made a video of it. I bought the stocks first. So I bought the chunk and then I play within that chunk. I just sell the call and the put at the same time, and I just churn away the premiums. If nothing happens, then I collect the dividends as well. So it makes sense for me. It's like winning in 3 different ways possibly. And let's say if the stock does hike up 5-10% and somehow I lose some shares, like that is capital gains as well. So I'm winning 4 ways possibly. You can make these plays for pretty much any stock. On the other side, I have the tech stocks, which have like Teslas. I tend to sell calls when things get like a little bit overhyped and when people get like fearful, when it drops from $900 to $600. I sold puts for $300. That's when people got fearful, and I collected premiums there too. Yeah.
So going back to your first example, which sounded like the most interesting, I believe it's called a short strangle or short straddle, where you sell both a call and you sold a put. So if the stock doesn't move, you just get the premium, you're happy anyway. If the stock goes down, then you get more shares, of that stock. and then of course you'll get more dividends. If the stock goes up, then you lose, I'm assuming, only some of the stock, but you've been collecting dividends all along as well.
Yeah. So even if it stays flat, I'm making money
Yeah.
like three ways. But that requires some attention as well. It's not just set it, forget it type of thing. Yeah.
It depends whether you want the stock or not, I suppose.
Yeah, exactly.
Okay. So is that one of the more successful ones for you, that you're kind of making money multiple ways, but you're also having to look after it a little bit more?
Yeah. This is something new for me. And to add to that, I actually used margin and I doubled my position because my margin rates at Interactive Brokers was only 2%, but this Enbridge paid out like 7% back then. So I just doubled it and it made sense for me.
All right. So it sounds like you take some risks as well along the way.
Yeah. I went for some leverage for sure.
Should do a public service announcement. Using margin accounts will increase your risk profile.
Yeah, and also increases your returns too.
That's true. That's very true. Okay, well, that's quite the strategy, and it sounds like it's producing good cash flow for you.
Yeah.
Okay, well, excellent. I use something very similar, so I keep buying, like I said. With the options, I do mostly cash covered puts on stocks that I don't mind getting. If I do get it, great. If I don't get it, well, then I collected the premium and that was fine. What I do like, though, is that with options, you really don't need any capital upfront until you possibly get that stock. So you could be making a 20-30% annualized return off of nothing. If you have a margin account where I have the purchasing power to cover the put, but I don't actually have to supply cash until it actually does happen and I get the stock. So I'm making 20-30% off of nothing, which I love. But yeah, with the dividends only make 3-4%. That's the thing. So I actually do like the options. But having said that, I'm still wary of them and I don't go all in. So I think the most exposure I've ever had was about 60K. But so far I've collected, in the 9 months, I've collected about 17,000 in premiums. So yeah, not bad. And I've got a few stocks, of course, along the way, which then I have to finance. I think it turned out okay. The other observation that I had, dividends versus the options, is that dividends are sort of more certain. You see that they're coming up, and unless something horrible happens to that company, that dividend is going to be there. But I think people are tempted with options if it's like, okay, I need to pay my credit card off. Okay, I'd better do an options trade. They might force themselves into something that's either high return or into just something that's inappropriate. They're like, okay, now I've got it. I don't know if this is going to be good, but okay, let's see what happens. With dividends, there's a relatively low risk, but with options, I mean, bad things can happen. So it's better return, but yeah, more risk, I think, is the theme that we're trying to set across here. Either you have to buy it back or you have to get the stock. So like, you have to plan ahead. Before you sell the option, you need to know, okay, I'm going to buy it back, or I want the stock, and here's the money sitting in my savings account that I can buy the stock with. What do you think for your cash flow? What percentage do you think comes in from selling either covered calls or cash covered puts versus the dividends?
Yeah, I definitely make a lot more from selling premiums.
Okay.
But a lot of times I use that to buy options. So that kind of funds my call and put options, which is a different play on itself. But just comparing dividends to selling options is hands down is selling premiums. And I think the number would be like at least 3-1. At least.
Oh, wow. Okay. All right. Well, you're more adventurous than I am. I'm 4 times as much in dividends on a yearly basis compared to what I've, in the 9 months, I've gotten from the premiums from selling the options. I haven't really gone big with it. Like I said, the most I've had at risk was 60 grand. It's sort of exhilarating and wrong at the same time.
Yeah, it's not for the faint of heart. Yeah, for sure. Like, I think I did a video early January and I was just counting like how much premiums I collected on like the 3rd Friday of January, and I had no idea. Like, I normally never count, I never track it, I don't have a spreadsheet, and I was counting. And then because I think last November things were very volatile, things were dropping like crazy. It was dropping like 10% in like 2 weeks or whatever, and then that's why I made some plays. And then in that video I counted, I got like 12,000 US just on that collecting on that day. I didn't know how much I was risking, maybe like $500,000, but
well, okay. Yeah, I mean, percentages need to be used. Yeah, if you've got a huge amount at risk, then
yeah, I've been doing this for a while, so it's not that bad.
I think you're supposed to limit each trade to about 2% of your portfolio, just so you don't blow it up, basically, right? It's like some people go all in, and especially if they've had some losses, it's like, okay, I'm going to do this one big one and I'm going to make everything back up. That's when they lose even on that one, and their portfolio is gone, and there goes the options trading. It's over.
Yep.
I mean, we all learn as we go, and I made mistakes at the beginning, buying stocks for the premium on the covered call, or getting stocks that I didn't want from selling puts on them because they had high premiums. So while that helps the cash flow, it's not great, but it's nice to have the dividends to kind of backstop you, that that you can pay your credit card bill and you can pay your strata fees out of the dividends, and then just play for the options premium with stuff that you can sort of afford to lose. It is like going to the casino, I think, in some cases. So do you want to give a quick summary? I think we both sort of agreed we're both in the same boat.
Yeah, pretty much. I think if you've invested in dividends all your life and you kind of want to get exposure in options, just sell like one contract a month and just observe how the prices swing. Start off easy. Don't go like, oh, I want $1,000 a month type of thing. Just take the $100 first and then build it up. Build up your risk tolerance, because it's not for the faint of heart, as I said. Yeah.
While the dividends are for the faint of heart, because especially North American companies will do anything and everything to prevent themselves from cutting those dividends. So yeah, the dividends are usually fairly safe. So if you want to supplement your income a little bit, how does the BC Lotto go? Know your limit, play within it.
Exactly. Yeah.
Yeah.
Good motto.
I know we've made several comparisons between options and gambling. Might be a great trend.